we've seen banks and financial institutions fail all over the world, and we've seen different countries get into quite some troubles. We take Iceland, for example, they're in dire straits. What do you see as being the situation in Australia? Is the worst yet to come? Have we weathered the storm fairly well? What is the situation in Australia? So this is one more genuinely for an open forum. What do we think is around the corner? Anyone?
Probably get 3 different views out of this one, I'd say.
Maybe so. Maybe so.
I think just, and I'll start off. I think one of the things I'm sort of on the lookout for is unemployment. So as an economy, so I think the big issue really that I take from what you are is the economy itself is the next risk, I think. So what I mean by risk is the risk that there'll be prolonged slowdown and we will end up in a recession. So I think there's a very real risk of that happening. There's some indicators saying that the terror period is starting to slow a little bit. So the stock market's bounced a little, and some of the spreads on debt, especially short-term debt, have started to normalise a little bit. And if you look at the volatility in the equities market, that's starting to come back as well. Although, having said that, the volatility is definitely above average in the equities market. So I think there's some optimism in terms of the system's not going to melt down. So I think that's the first part. So there's the terror of, will there be a financial crisis in terms of, will it melt down, will the system stop, will it grind to a halt? For a long time, I think there was a pervasive view, and this is reflected in the relationship banks have with each other, that maybe the system might stop. Now that might seem like a very, very profoundly, over-the-top statement, but if you consider the way banks relate to each other, they stopped lending each other money because they didn't understand the balance sheets of other banks. Not they didn't understand them, they just didn't have that information because it wasn't divulged to them clearly enough. Now, if a bank doesn't lend money to other banks that have the same credit rating as them, to me, that gives me an indication that perhaps they're not so confident in their own credit structure. And perhaps they might have some stuff on their books that they're not divulging either. And that could be in the terms of bad loans, excess liabilities, but also in terms of their solvency position. What is my maturity mismatch on my short-term funding and my longer-term obligations? So I think some of those things are starting to calm a little bit now. I think the bigger issue is, is there going to be a prolonged slow period? I think for Australia, I think will be driven by international factors. I think China slowing down, as Brad said before, very important point. What happens in the United States, and I think the global sentiment has a huge impact on us here in Australia. But having said that, I think we've got relatively strong structures. You hear it bandied around pretty regularly that the Australian banking system is quite strong relative to other countries, and I believe that. And I think our economy is relatively robust in that I don't think we have any internal huge issues. One thing I'm not so happy about is the first home buyers grant. I think that's a sort of weird way to stimulate the economy. I think putting money into the economy at the moment is a very good idea. The government's spending on initiatives, they're building infrastructure, they're putting money into training, and putting money into small business. I think that's a good thing to do. I think putting money into the housing market is a bit of a weird thing to do in that you're putting money into a market artificially inflated.
Just on that, Glenn, by having this first-home buyers grant, are we sowing the seeds perhaps for another subprime situation? Because some of the analysts are saying we're giving a lot of people and we're assessing them on the basis of the handouts that they've been given. We're in a very low interest environment. If the interest rates were to go up much, there's some views that these young people who have just bought houses are going to be in some financial stress. Anything about that?
Yeah, I'll just a couple of points on that. Generally speaking, as a rule of thumb, banks do adopt a qualifying rate when assessing a loan application. So even though the lending rate may be equivalent to 5 or 5.5% per annum, banks will typically apply a buffer on that. That buffer depends on market conditions and they apply around about 2%. So a qualifying rate for the loan application, say 7% per annum. So we'll assume a further 2% rate increase. In terms of the housing market and the presentations around first-time loans grant. As I agree with Glenn, and I personally believe that the lowering of the market at the moment is very highly driven by first-time buyer inquiry. We're seeing, particularly the new stock at the lower end of the market. When I say lower end of the market, any new stock purchased between $3,000 and $500,000 is selling quite quickly and quite easily. So it's a very, very good opportunity for developers, particularly in those markets, to actually dissipate or sell their stock. And the reason they're able to sell so quickly is first-time buyers are receiving a $24,000 first-time owners grant in New South Wales for new stock. They're paying no stamp duty up to $500,000. And there's a period of, or currently a period of very, very low interest rates. So from an affordability perspective, and from a cost perspective, actually it makes a lot of sense. The concern is that if that grant was to be removed or reduced, if rates were to increase a little bit more, if unemployment was to rise, what stress does that put on those first-time buyers? And I would argue that's going to put a lot of stress on them. So that's fundamentally a lot of concerns around that. Having said that, we are in an environment where we've moved away from lax lending practices. A lot of these low doc, particularly high LVR low doc loans, are no longer available. Many of the banks have actually moved out of low doc lending. And so we're seeing that credit across the board is tightened. It's tightened quite significantly. There are very few, if any, banks offering 100% financing in today's market. In fact, most of the banks have reduced their lending ratios down to 90% on residential lending. There's talk potentially those lending ratios might come back a little bit further. So it's just an interesting time, and those first-time buyers who are rushing to the market probably don't necessarily